We've all heard the phrase rent money is dead money, right? Well, is it really? Look, as property prices surge and affordability challenges mount, especially for many younger Australians, I know a growing number of people are turning to an alternative path, rentvesting. That's where you rent the home where you want to live in the location where you want to live and can afford to, but invest in a property elsewhere because you can't afford to buy where you want to live. Anyway, is this just a clever workaround? Is it genuinely smart? Will it help you build the wealth you want? In today's episode, I'm joined once again by Stuart Wemyss of Pro Solution Private Clients to explore this in depth. And even if you're not particularly interested in rentvesting at the moment, I'm sure many of the investment principles that Stuart and I are going to discuss are going to be of benefit for everyone interested in property. So welcome to another episode of the Michael Yardney podcast, where we help investors gain clarity amongst the confusion of all the mixed messages regarding the property market. I want to help you develop the financial freedom you're looking for through strategic property investment and smart money management. And that's what we're going to help you with today as we unpack the story of rentvesting. Let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Welcome back, Stuart.
Great to be back with you, Michael. Thank you for having me.
Now, you've been a regular on the podcast for years, and I've always recommended your blogs and your Investopoly podcast. However, there are so many new listeners and new viewers who don't know you. I suppose I should explain that you've been in the financial industry for decades. You're a qualified accountant, mortgage broker, financial advisor, and the founder of Pro Solution Private Clients. But more importantly, you're someone I really respect for your clear, your no-nonsense take on money, investing, and the property market. So I was interested in a fantastic article you recently wrote unpacking the pros and cons of rentvesting versus traditional home ownership. Was impressed because you always run the numbers. That's what your mind works like. So if it's okay, Stuart, today I'd like to explore whether rentvesting can actually leave you better off financially, or is it the right thing to do? What made you write this article, Stuart?
It's always been a bit of a popular topic, I guess. And I guess as markets become more expensive as well, like investment markets, people start to think, oh, well, it's almost one or the other. I either buy my home or I invest rather than doing both. And so, I think, obviously Brisbane and Perth, Adelaide, they've all sort of advanced, and not necessarily Melbourne and Sydney as much, but in more recent years. And I think that's probably what sort of resurged the topic again. And also, when we build plans for clients, we start with a very open mind, particularly if the client has suggested, yeah, we're happy to explore any strategy. And so sometimes we also then think about, what about a rentvesting strategy for clients? And
let's make it clear. Sorry to interrupt you, Stuart. Let's define what rentvesting is before we go any further.
Yeah, so it's to rent where you want to live and invest where it makes the best sense to invest. And I think it's
where you can afford to, I guess, if you can't afford to buy where you want to live.
Yeah, that's right. And look, I think to some degree, I wonder to some degree, Michael, whether it's people trying to have their cake and eat it too. To say, I don't want to compromise where I want to live and I can't afford to buy this, I'll rent. But I also want to invest, so I'm going to do that as well. Or whether it's really a case of, because rentvesting could also be useful if you live in a location that's not investable, not investment grade. If you lived in the middle of nowhere, for instance, where land supply is abundant and there's no demand for housing in that location, well, it's probably not going to be a good investment per se. So in that situation, rentvesting could make some sense. But, I wonder if today, whether people just aren't willing to do the hard yards of making a compromise, and maybe living in a property that makes an otherwise good investment, but not something that they really foresee them being in for a long period of time.
Well, actually, what you said just reminded me of somebody I spoke to the other week, a lovely lady who lives in Moranbah, and she lives there because her husband works in the coal mines. But they also know that it's not an area where you'd want to keep owning properties over the long term. So they rent there with their family, with their 3 kids, but have got investments elsewhere. So that makes sense. But When I grew up, I was told the old idea of rent money is dead money. Is that an outdated concept?
I don't think so. I mean, I think it's like any sort of strategy. It's not an absolute situation in that there's going to be some people that rent vesting will suit and that in fact it is the best strategy. But I think from our numbers and our analysis, it's overstated. I think that the number of people that rent vesting suits is probably a very narrow part of the market. I think most people in general terms would be better off eventually owning the home that they live in, which I'm sure we'll talk about.
Well, I agree with you that owning a home, especially in your older years, is important. It's a shame when people get to retirement age and still have to pay rent. But one of the challenges I've seen is people rent vest and they buy a number of investment properties and they haven't actually got a system, a plan in place to have sufficient equity to buy their family home that they initially want to. I know you ran some numbers in your article and I'll leave a link to your article in there. So maybe you could just walk us through the numbers.
Yeah, I mean, it's always difficult to talk through a financial analysis in a podcast or a video, so I'll try not to confuse people too much. But essentially, what we did is compared, somebody that went and bought a home for $1 million, or someone that rent vested and bought an investment property for $1 million. And in both those scenarios, we repaid debt and invested remaining surplus cash flow. So we had some superannuation and then invested remaining surplus cash flow in shares and so forth. And we did those projections over 30 years and even beyond that as well. So much longer term projections, because I think this is where rent vesting starts to sort of fall down, if you like. One of the things is, one of the benefits of doing these financial projections isn't necessarily trying to predict the exact outcomes of a particular strategy. So that is, we're not trying to necessarily accurately predict you will have $5 million in today's dollars in 30 years' time, but it's really about comparing the performance of those two strategies using the same assumptions, but just obviously changing the strategy. And that's the key thing here. So we shouldn't get too caught up in the numbers because, of course, we're confident with the assumptions we've made in the modelling that they're conservative but realistic. But of course, everyone's situation is different and it's going to produce different results. So we modelled those two scenarios where we're investing in $1 million property versus occupying $1 million property. The rent vestor in today's dollars was about $300,000, built $300,000 less wealth. So it's about 5.5 versus 5.8 in terms of rounded numbers, in terms of net wealth in today's dollars after a 30-year period. So it's a pretty significant difference, I guess, and that's today's dollars. Like if I was going to put another 300 grand in your bank account, Michael, I'm sure you'd be very open to it. Yeah,
yes, thanks.
It's not a small number, but I think the key thing, the key thing which we'll talk about is how rent vesting really performed in retirement. It's not so much during the accumulation phase of when we're working. It's really how it performed in retirement that was the difference. And so we took those projections out even longer beyond that 30-year period through into retirement, and the difference increased to about $2 million difference in today's dollars.
So you assumed that they never eventually bought their own home, was that right?
That's exactly right. And that's the key critical component here is what we found by looking at this modelling is it's the existence of a perpetual rental expense that really aid into investment assets. So as you can imagine, the average sort of middle class person will spend somewhere between $80,000 to $100,000 on general living expenses in retirement. But if you need to then pay for, say, $50,000 or $60,000 of rental expense in retirement, well, all of a sudden you need a lot more from your existing asset base. And so it eats into that capital a lot quicker and at a lot faster rate. And you just got to ask yourself, if you're in that situation where you stop working, so you're wholly and solely reliant on investment returns for income to pay for living expenses, how comfortable are you going to be to continue to rent in that environment, knowing that you're eating into those savings and your only solution at that particular period of time is to then go and buy a house? But then if you go and buy a unit, whatever it is, a property, but if you do that, then you're obviously going to evaporate your retirement savings even further. And so I think that's the main issue.
I think there's another way of looking at those, Stuart. I mean, the great Australian dream has always been own home ownership, stability, security, personal achievement, not just for the Australians, but the many migrants who are coming here as well, because they're coming here with the aspiration of owning a home. But the way we're living now and demographics is different. People are staying at university longer, getting married later, having gap years, not putting their roots down, not forming a family. So maybe don't need to own a home as soon because they're not having children. So many of the people that I see interested in rent vesting are doing it as an intermediary stage. I don't know where I'm going to live in the future. I don't know where my jobs are. Very different from my age as a baby boomer, where you started your family much earlier, you put your roots down earlier. So there's been a significant demographic shift, which means that home ownership rates in Australia fall for a number of reasons, but particularly so in the younger generations.
Yeah, definitely, Michael. And look, I think, as a general rule, my view would be that you should buy your forever home as soon as you possibly can. But to do that, you need to have a clear and confident idea of what that looks like in terms of which locality and what sort of type of property that is. And also, it might not be a sort of one-step approach. You might actually have to buy a home and then upgrade eventually to that forever home. But the idea behind that advice or strategy is that we have to pay for our home using after-tax dollars. So it's quite costly because, of course, we've got to pay the tax and then eventually we've got those after-tax dollars to pay for it. We're either going to do that through saving money or paying off a mortgage, both of which are expensive. That means that if I delay buying that forever home for a decade, for instance, the chances are that same property that I could buy today is going to cost me a lot more in a decade. I don't know how much, let's say $500,000. So if I've got that's another additional $500,000, but it's probably more than that because it's interest as well, that I need to find over the rest of my working life to pay for that asset. So I'm not saying people should just rush in and go and buy any old property. I'm saying as soon as you have a clear and confident view of where you would like to be longer term, then that's the time to make that move. But equally, if you're not clear, don't throw darts at a dartboard, particularly if it doesn't make an otherwise great investment. Because I've actually seen clients make mistakes as well as saying, well, we think we might want to be in this area in 10 years' time, so we're going to buy that property. Life always changes, right? Goals, views, etc. They're always going to change. So who knows what you want in 10 years' time? But as long as that property would make an otherwise great investment, you're probably not going to worry too much. But if it doesn't, then that's when you don't want to make that mistake.
Well, while it's a good idea to own your forever home as soon as you can, as you say, it's usually a stepwise thing because people can't afford, when they started in the market, getting to the sort of property it took their parents 30, 40 years to be able to afford. But one of the great things about the Australian system at the moment is there's no capital gains tax when you sell your family home. And I know a lot of people actually keep their first home as an investment and move on. In your article, you run through some of the pros and cons of rent vesting and home ownership. So maybe we could just jump through those, because there are advantages and disadvantages. And as you clearly say, there's not one right answer that fits all. But if we go through the advantages of rent vesting, the interest is tax deductible interest on your loan, but so are the property expenses as well. And the rental income comes in, it helps pay for your mortgage. And so in the short term, you may not be worse off cash flow wise. And as you've said a few times, it really gives you the flexibility of not having to buy your family home straight away. And you can probably invest in better locations than where you want to live if you live in the wrong areas. And you can, I guess, in the short term, realize sell value. Then on the other hand, you're renting with after tax money, unlike the mortgage on your investment property. You pay land tax on your investment property. You'll have to pay capital gains tax if you sell, and you don't have the security. I guess that's one thing that you can't put in a spreadsheet, the feel comfort of having your own home, being able to put pictures on the walls, even though tenants have got much more rights at the moment, and you're at least in the property market. So there's some of the advantages of rent and disadvantages of rent vesting. What about home ownership? Maybe you want to go through the pros and cons of those.
Yeah, definitely. I mean, let's talk about the capital gains tax and negative gearing, because they're two significant tax benefits potentially to either the investor or a homeowner that can often confuse people, in terms of weighing up which is more important. So it's an important conversation to have. the benefit not to pay any capital gains tax on our main residence, and of course we can only claim one main residence at a time, as an individual or as a couple, is a real advantage in terms of being able to utilize equity to continue to upgrade property. And so, if I can buy an asset that is not my forever home, but I know is going to be a great investment, make some improvements to that asset to obviously manufacture some equity, and then ride out a growth cycle, I can then crystallize that gain and not pay any tax, and then take that wealth and then put it into my next property. That is a really powerful strategy that avoids the being hamstrung by a really large mortgage. It just means you need to borrow. If you do really well out of that transaction, you borrow less on the other side. And it has a compounding impact too, Michael, because if you're borrowing less on the other side, it means you've got more surplus cash flow to invest in other assets, whether it's property, shares, super, and you can utilize that equity as well in the home in terms of borrowing against it. So it's a really valuable benefit in terms of avoiding capital gains tax. But
So your home is really an investment, Stuart, and it's one that, even though the mortgage isn't tax deductible, boy, are there some great advantages. If I could just interrupt your train of thought for a second, that's one of the things that those who say tax investors more, charge them more capital gains tax. They don't mention the fact that 70% of Australians who own their own home have this amazing capital gains tax-free investment I'm not suggesting we should tax the capital gains on your home, but no one ever mentions the counter argument that so many Australians build their wealth through the method you've just said. Paying off their home, allowing compounding leverage and time to increase the value of their property, and then taking advantage of that extra equity.
And we've got to realize that the tax system is structured in that way, that there is a big advantage to homeowners. It's a big free kick. You can buy a family home in a great location, occupy that property for 20 years, not necessarily repay the mortgage, and then walk away as a sort of downsizer strategy with a lot of money in your pocket on an after-tax basis. And that's a massive free kick. I actually think they should have a lifetime cap to the main residence exemption, by the way. People that are selling properties buying for 10 million and selling it for 40 million a few years later, I think deserve to pay a little bit of tax. But anyway, let's get back to the argument around negative gearing, because negative gearing is actually generally more valuable than a capital gains tax saving.
Is that because of the cash flow implications?
It's because of the time value of money. Exactly right. And the affordability of it. So, I remember I did an analysis for buying or investing in property inside a self-managed super fund. And if you do that and you sell the property when you're in pension phase, you potentially avoid paying any capital gains tax. But the negative gearing benefits are much lower because the flat tax rate inside super is only 15% during accumulation. And so I modeled it compared to paying the full whack of capital gains tax outside of super, but at least getting the negative gearing at 39 or 47%. And it actually was even. The benefit from no capital gains tax inside super was offset by the lower negative gearing benefit. So it shows me that negative gearing benefit is actually really valuable too. Now that's confusing, right? Because I've just said you're better to be a homeowner because you get the no capital gains tax. But by the way, negative gearing is really beneficial as well. I think what people need to do, or mostly do, is work out how can they best utilize the main residence exemption in their financial strategy. So, you say all the time, Michael, buying a property is not a plan. And it's true. You need to have that plan to kind of work out, well, how can I use it? Because people that are starting off with a relatively low asset base, one of their best advantages is possibly, using that main resident exemption to sort of build after-tax wealth.
Interesting. So there are opportunities. There are times when rentvesting makes sense. We've already said that. If you live in an area that doesn't offer strong capital growth, or if you're not sure where you're going to live, you don't have specific plans, or if you are going to be moving around in your job or working overseas. But I guess what you're saying is even if it's not your forever home, buy your home where your family is going to feel secure sooner rather than later, because there are advantages. Is that how you'd summarize it?
Yeah, that's right. And the other advantage of buying a home and then gradually repaying the mortgage, because that's typically, when we buy a home, people then become very focused on repaying the home loan. and
Yeah.
arguably sometimes too focused, but I'll come back to that in a second, is one of the benefits is that as we repay the home, our housing cost for our household is actually reducing over time. Now, that's because we're putting more capital into that property, of course, by repaying the loan. But the whole point is that I start off when I first buy the property, my mortgage repayments are quite high. As I get deeper into that, my mortgage repayments are reducing because obviously that loan balance is reducing, particularly as I refinance through that. That then gives me, puts me in a better situation because I need fewer after-tax dollars to pay for my living expenses and housing costs. And it means that I can put money towards other areas like investing in property, super, those sorts of things. The problem with rent vesting is that cost continues to rise because obviously, well, you look at the long-term average increase in rental income over multi-decade periods, about 4.2%. So that our housing costs are actually going to rise, compound by 4.2% on average over a longer period of time. That actually eats into my ability to, invest in other assets. So from a long-term perspective, and that's what we saw from the projections, right? We saw, firstly, housing costs were reducing in one scenario, but rising in another. And then the impact of having, needing more money in retirement on an after-tax basis into the asset pool. But the other thing then too, Michael, is the liquidity of property becomes a problem as well in retirement. So if I'm
Yes.
rent vesting, the general definition is I'm going to rent vest because I'm going to invest in property elsewhere. So if I do that for my whole life, I'll get to a point where, hopefully I still have some super, so I've got some liquid assets, but most of my assets are going to be held outside of super probably. And most of it's going to be in property. And we all know property generates a relatively low income after paying for all expenses, particularly the right property, because they're probably going to be land heavy, which means our land tax bill continues to increase. So we actually get to a point or a stage where we're then forced to sell those properties just because we need some liquidity. We need to be able to pay for the rental expense and living expenses. And we're selling in an environment where we're still going to pay capital gains tax versus we can each have $2 million inside super and not pay any tax. The rent vesting, you've got to think about
Moment.
at the moment. It's always going to change, but there's always going to be some tax-free limit to super, of course. So actually rent vesting ends up being quite inefficient from a tax perspective and quite inefficient from an asset allocation perspective. And it kind of makes sense, right? Michael, we know, we've been around long enough to know that moderation is the key, with everything. It's a little bit of everything rather than one of one thing. And it's true when it comes to building wealth as well.
Well, so you've advised clients in a lot of these decisions at Pro Solution. What mistakes do you see rent investors make that derail their financial goals?
At some point, Michael, in my experience over the last almost 25 years, even the most aggressive rent investor that walks into the office will change their mind at some point. So I've had lots of situations where people tell me, Stuart, we don't care. We're lifelong renters. We don't have this sort of emotional need to own where we want to live, et cetera, et cetera. As soon as they say that, I think in the back of my mind, okay, one day they're going to walk, it could be 10 years, could be 5 years, could be 15 years. They're going to walk back into the office and say, we've changed our mind. The problem with that is it's a big ship to turn because if they're being so committed to rent vesting, it's very likely they've put all their borrowing capacity into building wealth, into buying pure investment properties. And so by the time they get to changing their mind, which could be sort of 10 years down the track, they've got no surplus borrowing capacity. They actually can't afford to buy a home without selling the investment properties. And there's one thing that you shouldn't do with compounding capital growth is unnecessarily interrupt the benefit of that compounding.
No.
So it actually destroys a lot of value because just because they've changed their personal preferences, which is fine. There's no judgment there, of course, but they have to then unwind, a lot of the good work that they've done. So I just think and that's my experience. Now, of course, there's going to be some people, there's someone in Australia, I'm sure, that are happy to rent vest for their entire life, full well knowing the pros and cons. So it's not everyone, but it's most people, and it's everyone that I've come across over a very long period of time. So I think that's the thing is being too short-term focused and not really thinking or leaving room for the possibility and answering the question, what if I change my mind? What if I actually want to buy a home down the track?
Yep.
What is the impact of the decision?
Finally, if somebody's sitting on the fence now, having listened to this, torn between buying their own home or starting with the investment property, what are the key questions they should be asking themselves before deciding?
Look, I think that first one is, once have I changed my mind? So if you're happy to rent vest, then, what happens? I think, but most people, I would say, even the people that are currently rent vesting might still be very open-minded of having a home one day. The things that I'd be asking is, where do I live, and is that an investable location? Can I make some lifestyle compromises? If not, and move to a location that's more investable within my budget? Because sometimes the best thing that you can do is kind of have your cake and eat it too, is to get into the property market, buy a property, go and occupy that property for a period of time. And then even if you change your mind and go and rent invest again, you can move out and you've still got that 6-year rule, the 6-year capital gains tax rule, that you can continue to claim that property as your main residence as long as you don't claim another property as a main residence. So you can have your cake and eat it too with rent investing by doing that. Go and buying a property, live in it for 6 to 12 months, then move out, go and rent wherever you want to rent, still have no capital gains tax to pay for up to 6 years. You can always reoccupy it and restart that clock again before that 6-year period is elapsed. And you still get the negative gearing benefit, but you're not going to pay the capital gains tax. So I think just try and understand the benefits of those sort of 2 tax breaks, if you like, and work out how important is it for you to exploit them to the maximum possibility. I mean, if you're starting from a very low asset base, I would say it's very important. If you've already well established, well, it's less important then, of course. And then work out how can you do that within your own strategy. And I think it could be a combination of, rent investing for a small amount of time with a view to obviously eventually being able to afford to own the home that you live in.
Agree with that last statement, but I also think you've got to understand what your timeframes are, because if it's only a year or two away, you're really unlikely to have developed enough equity, extra cash flow to do that. So I've seen people shoot themselves in the foot by rent vesting when they're planning to buy a home within a couple of years, and they're just not going to have enough money to do it.
Yep. Yeah, definitely. Look, property is a long-term asset. It's possible to buy a property and you're miles in front in 5 years' time, but I wouldn't build a strategy around it because there's lots of things that you can't control that are going to have an impact on capital growth. So it's really a 10-plus year decision, the way I look in terms of making a property decision, and hopefully much longer than that. Worst case, 10-plus years. So people need to be really careful about that. And sometimes I find, Michael, that investors and property buyers can be impatient sometimes and think, I need to buy something this year.
Yes.
It's not going to change your life whether you buy this year or next year. What's going to change your life is getting that strategy right and buying the right property at the right price point. That's far more important than trying to rush into the market. So definitely you want to make a good long-term decision.
Well, you've given us lots to think about. I'm going to link to your article in the show notes and also to your Investopoly podcast and blogs. But if people want to know a bit more about what you do at Pro Solution Private Clients, can you just tell us quickly how your team can help them?
Yeah, sure. So we work on a holistic basis, Michael, which we know that a lot of financial decisions are multifaceted, and property investing, in fact, buying a home is one of those things. Whether you should buy a home now or whether you should rent, invest, all those sorts of things. They're important decisions and they're multifaceted. There's tax, there's borrowing, there's cash flow, there's an ultimate retirement strategy. There's multifaceted factors that go into that decision. So we as a team of accountants and mortgage brokers, financial planners, collaborate together on the one client to deliver the best outcome to make sure that we do find the right strategy for our clients.
Fantastic. Well, as I said, I'll leave a link in the show notes. Thank you very much. Look forward to catching up with you again next month, Stuart.
Thanks, Michael. Fun as always.
Hi, before we get on to my popular mindset message, I want to now share with you my property trivia segment, where each week I'm giving you the opportunity to win a hard copy of one of my best-selling books, a real version of How to Grow a Multi-Million-Dollar Property Portfolio in Your Spare Time. I'm going to ask you a question and then just go to propertytrivia.com.au, enter your answer, and everyone who enters is going to get a copy of a new property report I've just written, and 3 people each week are going to have the opportunity of win a real hard copy version of my book. And today my question is about the fact that some of Australia's most desirable suburbs were once very different. So the question this week is, which iconic Sydney suburb that was once considered a slum is now one of the most gentrified and sought after areas in the city of Sydney? If you think you know the answer, head over to Property Trivia. I'll leave a link in the show notes. And each week, you've got a chance of being one of the 3 lucky winners of getting a hard copy of my best-selling book. And don't worry if you're listening to a slightly older episode. We still count your entry, and everyone who enters is going to win a copy of a brand new report I've just written about property. Before I share my popular mindset message with you, I want to point out something you probably already know anyway, that the property market's already turning. The government is now fueling the flames of our housing market with their housing policies, with the Big Australia policy, at a time when we've got a chronic undersupply of homes. And that sets the stage for the next leg of our property cycle. And with multiple interest rates likely over the next 12 months, we're entering what I see as a rare window where today's decisions could mean your financial security tomorrow, or it could mean a missed opportunity. Look, by the time all the headlines start talking about a property boom, it's too late to get in, or it's too late to get in early. And at Metropole, we've seen this before. Buyers hesitate, then confidence returns, then FOMO kicks in, and all of a sudden prices start to surge. So my recommendation to you is don't wait for the crowd. In fact, get in ahead of the wave. So I'd like you to take the opportunity of having a complimentary wealth discovery consultation with one of our wealth strategists at Metropole. Together, we're going to clarify your financial position and what you want to achieve. We're going to talk about what makes sense of where the market is at the moment, where it's heading, and of course, answer your questions about that. We'll also help explain how you could position yourself to take advantage of the opportunities that some are going to miss until it's a little bit too late. And we're going to explain how we can develop a strategic plan tailored specifically for you. Look, the markets move in cycles, but wealth is built by those who act during the turning points. And that's what we're experiencing at the moment. So don't be the investor who looks back in 12 months' time and says, I should have. So go to metropole.com.au and book your free wealth discovery chat today. It's your chance to make confident, informed investment decisions before the rest of the market catches on. metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I want to ask you a question. Maybe you're not actually going around in circles. Maybe you're climbing. This is something interesting I read. I saw an actual meme on this on social media, and it made me think about it. See, if ever you felt you're putting in effort, making all the right moves, but the outcomes aren't what you expected, they're nowhere in sight, you've often felt downhearted a bit. Maybe your property portfolio hasn't grown the way you'd hoped. Maybe your business feels like it's hit a plateau. Maybe you've done everything right, yet it still feels like you're spinning your wheels. Well, you're not alone. But what if you weren't going around in circles at all? I guess that's what I'm wanting to ask you. What if the path is actually a spiral? And that's that interesting meme I saw on social media, because it came home to me when I read a quote also that said, you're not going in circles, we're going upwards. The path's a spiral. We've already climbed many, many steps. So here's the catch. From where you stand right now, it looks like you've been there before. The same obstacles, the same doubts, the same grind. But zoom out just a little and you'll probably see it differently. Yes, you've been there before, sure, but this time you're handling it better, smarter, calmer, more strategically. That's not stagnation. That's elevation. So here's how you know you're growing, even if it doesn't feel like it yet. You've stopped reacting to every market hiccup with fear. You're not chasing every shiny strategy or the next hotspot anymore. You're sticking to your strategic plan. You've learned to say no to the distractions, energy drainers, and short-term thinking. You know that you're growing when you stop trying to impress others and started building what's right for you. You know you're growing when you cringe at where you were 6 months ago. That's a sign of progress. Or when you've become more intentional, more resilient, and more focused. These are invisible milestones, the ones the outside world won't clap for, but that quietly shape the path to your long-term success. So if you're doubting yourself right now, I want to offer you a reframe. Maybe you're not stuck. Maybe you're just spiraling upwards. So Yes, the steps look familiar, but that's only because you're circling higher and higher with each round. So my message to you today is keep going, keep climbing, because growth doesn't always come with fanfare. Sometimes it just comes with better decisions, better boundaries, and a better version of you showing up to do the work. Your future self will be proud of how far you've come so far. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen-to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. And I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney Podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney Podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?